Okay, so our previous question dealt with cash receipts. So it stands to reason we're going to have something a little bit different here. Just looking down to the question, it says the cash payments this time for Finch Company for the month of June are what? Okay, well, I have no idea, and neither do you. So let's look at our scenario. It says this Finch Company began operations on March 31st of the current year. Finch has the following projected costs. And looks like they have manufacturing costs, insurance, depreciation, and property taxes. April, May, and June. Now they asked us about June, so let's see here what it says. It says of the manufacturing costs, 3/4 are paid for in the month they are incurred. 1/4 is paid in the following month. Okay, so that's pretty much exactly like the PowerPoint slide we had. What else? Insurance expense is $1,000 a month. However, insurance is paid 4 times yearly in the first month of the quarter. Example, January, April, July, and October. And property tax is paid once a year in November. Okay, well, they actually made this really, really easy for us because we don't have to worry about the property tax. We don't have to account for that whatsoever. We also don't have to worry about this number 2 item, insurance expense, because it would have been paid in April and then it's going to be paid in July, but they're asking us about June. So all we have to do is we just take our 216,000 or 217,000 600. This is the first step, and we just multiply that by 75%, right? Wrong. We need to account for this depreciation expense right here. I want you to understand that we're not saying that depreciation expense is $2,000 of equipment that's being depreciated that we paid $217,600 for. There are other manufacturing costs. Some of this is expense items, some of it is not. But we're going to subtract that $2,000 out, and that's going to give us $215,600. For the month of May, we had $195,200. We also had depreciation expense in the month of May. So if we subtract that out, we come up with $193,200. Now we're going to come up and we're going to say, okay, we're paying 75%, 3/4 are paid in the month they are incurred. 1/4 is paid in the following month. So this is going to be multiplied by 0.25%. So if we take 215,600 times 0.75, we get 161,700. 193,200 times 0.25 equals 48,300. And then I'm going to add back in 161,700 from the first step. $210,000 is our answer. Okay, let's see here. Let's do this. Let's go ahead and skip down to this second question, and then we're going to come back up and do this question, because this second question actually shouldn't take as long. It says Southern Company is preparing a cash budget for the month of April. The company has $12,000 at the beginning of April and anticipates $30,000 in cash receipts and $34,000 in cash disbursements during April. Southern Company has an agreement with its bank to maintain a minimum cash balance of $10,000. To maintain the required balance during April, the company must borrow what amount? Well, this is pretty simple. We just start off with our beginning balance of $12,000. We're going to add to that our $30,000 in cash receipts. And then we got $34,500 in cash disbursements. So if we take 12,000 plus 30,000 minus 34,500, we come up with 7,500. But wait, that's not exactly what we're looking for, is it? No, it isn't. This is not the way you would do this, but I'm going to write everything out. So we have to have a we have to have a minimum balance of 10,000. We have 7,500, so we're $2,500 short. And this $2,500 represents the amount that we need to go out and borrow.